In our profession, with the right knowledge and experience, the sky's the limit. And whilst we know the letters after your name are an important sign of standards, professionalism and trust, it's not all we're about. We're also focused on furthering our members' careers by giving you access to a community of like-minded professionals, all bound by the same code of ethics. There's newsletters, technical papers, podcasts, and so much more great content to facilitate your CPD. Like hundreds of regular face-to-face meetings and digital events, making it easy to stay on top of industry trends and to network with members all over the country. Our societies mean that whether you're a broker, claims, or underwriting professional, our approach is tailored for you. And with membership, you can work towards chartered status for a place amongst the experts in your field. If you have knowledge to share or want to learn, you can sign up to our e-mentoring platform to connect and exchange ideas and support. And not forgetting the perks. Save on a range of products and services, or access our legal helpline for free confidential advice. Get more from your membership today.
Good morning, everyone, and welcome to our Professional Focus webcast today with Flaxmans Partners, titled Policy Voidance, the Last Resort. I'd like to apologise to begin with for the delay in beginning this webinar. We just had a few technical difficulties, which often happens when we're all logging in from different areas. I'm Carly Knights, Professional Development Manager at the CII, and I have the pleasure of hosting today for you. Before I do introduce Roger and Michael to you, I'm just going to run through a couple of housekeeping points. Please do ensure that you have your devices on mute throughout the presentation to keep the background noise to a minimum. There will be time for a Q&A at the end of the webinar, so if you do have any questions or comments, please use the question box that you can see on your screen, and we'll work through these once the webinar is concluded. Your CPD certificate will be available for download at the end of the webinar, and any additional material will also be downloadable on the portal that you're currently on and that you can see. And finally, if you have any technical issues, please also use the comment box and someone will be picking this up with you behind the scenes. Now, you'll be able to see Michael on the screen, but unfortunately we can't see Roger, but he'll be dialed in, but you will be able to hear him. So let me very quickly introduce you to today's session. Roger Flaxman is the Chairman and Principal Advocate at Flaxmans, and he's presenting today with Michael Wilson, Director, and you probably have seen these guys before. Building on the previous successful webinars on the subject of non-disclosure and voidance, Flaxmans is now looking afresh at the insurer's option to void a policy and will be asking the question, is voidance the last resort? They'll be looking to see if insurers have other options that will still protect the insurer, but will be less draconian for the insured. So I hope you enjoyed today's webinar, and Michael and Roger, over to you.
Carly, thank you very much. And I'm very sorry that the local broadband has let me down at the last minute, but the phone is still working, so let's proceed in the dark, so to speak. So good morning and welcome once again to everybody. We had a terrific feedback from our last webinar about subcontractors. And coincidentally, we've since had a very unusual contractor claim concerning the hiring in of plant and machinery. The policy proved inadequate to meet the claim, not because of any breach by the broker or the policyholder, but because the terms of hire had not been appreciated by the policyholder, and on this occasion, they had a material effect upon the claim outcome. We intend to write this up into a webinar later this year, because we think it will interest you, and it's certainly a useful thing to brokers to know. Now, if any of you have a topic you'd particularly like us to address, please do say so. I can assure you we will never run out of topics here, but it's always nice to address something that we know the audience thinks there's a need for. Now, today we're addressing the vexing problem of voidance, and in particular, why it's important to understand its impact upon a customer. But before we start, I'd like to say something about the big picture of insurance. Our mission, in partnership with the CII, is to help to promote the trust of our industry, our profession, amongst the insuring public. And one of the best ways of doing that is to demonstrate common sense, good faith, and complete fairness in the treatment of claims. Now, of course, there are thousands of claims settled and paid every day where there is no complaint and they're perfectly fair and straightforward. But we also, all of us know that there are a considerable number of claims that are more difficult and where the customer is not fairly treated. Now, this is becoming more of a problem in our experience as insurtech seeks to drive a distance between the insurer and the customer. In an era where insurtech is taking control of the sales, the administration, and the claims handling, there are clear signs that the algorithms forming the decision processes are failing to meet the social objectives of insurance. Now, what are the social objectives of insurance? Very simply, they are to provide the money and the wherewithal to replace what is lost or damaged so that the insured's life can carry on more or less as before. Now, I know that's a gross oversimplification, but fundamentally, as we all know, insurance is designed to put you back in the position after the loss as you were in before it. So, in return for a premium and an honest description of the risk, the insurer undertakes to pay up when the event happens. Of course, the insurer has got to be protected against misrepresentation, dishonesty, fraud, exaggeration, and all that kind of thing. And that, of course, is why there are terms and conditions in the policy, including that avoidance of a policy. They're all to guard against the misuse of insurance. But the danger we are now seeing is that the algorithms that are being embedded into the systems are failing to include the nuances of insurance practice that actually makes it work and makes it fair. The immediate default position nowadays is to impose a penalty or a sanction where you and I, as insurance practitioners, know actually it's not really necessary to do so. But we also all know that once the computer says no, there's a reluctance by management and by operating staff to second guess it or to override it. And that is when things start to go wrong. Now, we all know from experience that there are many cases where there is a technicality, as we often call it, to give an opportunity to deny a claim. But we also know that it would be unreasonable to do so. We know that, but the algorithm doesn't. And our new and younger people in the industry, but in particular, not being fully acquainted with insurance practice, will never know that the algorithm is being unfair. And we'll give you an example of that later. Now, terms and conditions of the policy are there as a safeguard against the misuse of insurance. You can't have a policy without them, period. But they're not there to provide a game of chance between the insurer and the policyholder, i.e. who can win on points. Although increasingly that's what's happening, particularly where claims are outsourced to people, particularly lawyers, where they can take a point and say, oh, well, we don't have to pay this claim because of so-and-so. That's not the intention of insurance policy. But it's only people like you and us, experienced in insurance practice, that really understand the nuances between a technicality in a term or condition and the fundamental intention of the contract. Now, this brings me to the matter of the application of the law to contracts of insurance. Insurance practitioners generally have very little, if any, exposure to the law of insurance. And if the truth be known, most insurance people don't want to have anything to do with it. They leave it to the lawyers. But what's not appreciated is that the law interprets a contract of insurance rather differently from the interpretation ordinarily given to it by a prudent insurer or a competent broker. Both of those terms are what's used in courts of law. Now, this is the root of a lot of insurance disputes, because the expectation of insurance is what is said and written at the time of the sale. And when that is contradicted by the blunt application of law, the cracks in the so-called insurance promise become starkly relevant. Now, as a regular expert in the courts, I can say, or we can say, without hesitation, that there is a very stark difference in the way a court of law looks at an insurance contract and the way that we as practitioners look at the same thing. You may ask, well, how can that be so? The answer is that the law can only interpret the words, phrases, and expressions in a contract against their ordinary meaning, as words in the dictionary. But they won't take into account the ordinary meaning to experts in insurance like you and us. It cannot look at the intention of the contract. It can only look to a limited extent, to the context of insurance in relation to the facts. So this is a huge limitation, and one that can be as disastrous for the insurer as it can be for the policyholder. The recent FCA-BI litigation has been a very good example of that. Insurers, very confident of their coverage position, found otherwise. And policyholders, equally confident of their understanding of the cover that they've been sold, in many cases have been left very disappointed. So, in summary, the law is a very blunt and sometimes inequitable instrument in matters of insurance. And this is made worse by the fact that when the designers of InsurTech put the algorithms into the sales and transaction processes, they rely upon the basic words and phrases used in insurance to guide the algorithmic outcomes. And that is because it's not yet possible to infuse into InsurTech the nuances of human judgment and professional emotional intelligence aspects of insurance. But it is the human and the humane understanding of the written contract of insurance, with all its imperfections, and there are lots, which for 350 years or so have made insurance work in practice. Now that quality, that flexibility of interpretation and understanding in good faith is rapidly being dissipated and being lost by InsurTech, ignoring our history and our learned experiences. Consequently, it's only too easy for us in the industry to overlook the impact on our customers of our automated policy coverage decisions. Now, the voidance of a policy can and often does have a cataclysmic effect upon a business or a family. And in all conscience, it's something that we as an industry, nay, as a profession, should be very reluctant to employ, even if the lawyers make a case for saying we can. There is usually a better way of adjusting the remedy for a breach than the blunt and tragic consequences of avoidance. We just think about that. Now, the Insurance Act 2015 went a long way to dealing with these kinds of things, but perhaps not quite far enough. So, to sum up, the contract of insurance is only the written evidence of a much more complex and nuanced contract of good faith between the insurer and the insured. The interpretation of the contract requires human and humane understanding of the social objectives of insurance. InsurTech and the increasing distance between insured and insurers is, I'm afraid, damaging the very essence of the insurance promise. Voiding a policy, shall we say, inverted commas, because we can in law, is not a good advertisement for our industry or profession. So, with that introduction, which I'm going to follow up with another webinar sometime later this year or early next on this bigger topic, I'd like, Michael, if you'd like to make a start now with talking about avoidance in the context of our webinar today. And over to you. Let's talk about the learning objectives.
Well, thank you, Roger. Plenty to think about there. Thanks very much indeed. So our learning objectives today are on the slide. I better just read through them. To understand the meaning of policy avoidance and why an insurer might be justified to treat a policy as if it had never existed. To appreciate what an insurer must demonstrate before a policy may be voided, and to understand the different treatment between consumers and businesses. To learn from past examples so that delegates can form their own opinions as to the appropriateness of policy avoidance. Can I just pause there? Sometimes people might think, or delegates might think, that we're being controversial in what we say, and we're not here to tell people what to think. The purpose of these webinars is to provide the information so that delegates can come to their own opinions and their own conclusions. Next point, to know what the policyholder's future disclosure requirements are following a policy avoidance, and to appreciate the importance of accurate disclosure and a clear statement of fact. So those are the learning objectives. So what is avoidance? And I've put here, you say avoidance, I say voidance, let's call the whole thing off. There is no difference between the word avoidance and voidance. The two terms are interchangeable. When I say let's call the whole thing off, we're not really saying that, because there are occasions when it's only fair and reasonable that a policy is indeed voided. So I've put my own definition there, which is voidance or avoidance arises where a misrepresentation is so fundamental that the insurer treats the contract of insurance as if it had never existed. Now, just to pause here, that one of our learning objectives is to consider the difference between a consumer policyholder and a business policyholder. And this is where the difference between the Insurance Act and the Consumer Insurance Disclosure Act comes in. So for a consumer, if a consumer can show that they did take reasonable care in answering the questions posed, either at inception or renewal, but the answer is still wrong, it is possible that the insurer will not be able to void the policy for non-disclosure. Whereas with a business policyholder, there is no parallel opportunity for a business to prevent avoidance, even if there has been no carelessness. So the consumer is slightly more protected on this issue of non-disclosure. For a policy to be voided for a consumer, the insurer must show at least that the insured has failed to take reasonable care. Let's have a look at an example. This is an example of what I would call an ordinary decision by an insurer to void a policy. And the example here is a Mr. Jones, who's the director of Jones & Co. He insured a workshop belonging to the company. However, when presenting the risk to his broker, Mr. Jones failed to declare that 2 years previously, a workshop at a different location had been razed to the ground following a break-in. Now, such issues normally come to light when a claim arises. In this case, there was a new claim for malicious damage that arose when local youths had broken into the workshop. The insurer was able to show that had the previous substantial claim been declared, as it should have done, then it would not have accepted the risk at all. Consequently, it was justified in treating the insurance as if it had never existed and the policy was voided. I don't think Roger and I would have any issues with that decision. There are occasions when it's quite right that there has been a gross misrepresentation, and it's quite right that the policy is voided. We have two other examples to look at, which are actually quite similar. One is a a consumer issue, and the other one is a business policy. Roger, we've discussed the house on the hill issue 2 or 3 times, and we don't really want to go into all the detail there. But could you just remind us what the house on the hill case was all about?
Yes, yeah. This is the case where the insured had failed to declare to his insurers that his property was located within 200 meters of a watercourse. In fact, he didn't know it was, but it was a statement of fact issue. The statement of fact said that it wasn't, and it turned out that it was. There was, in fact, a claim for a flood, and the insurer exercised its legal right to void the policy because it was able to demonstrate that technically, had they known about the proximity of the watercourse, they would not have accepted the policy. Now, the fact is that this is the case that this house was one of a terrace house up the side of a valley in Wales, and the river was running a long way down about a few hundred feet below it in a valley, and it wasn't really a river, it was more of a stream. The loss adjuster said at the time there's no way, Noah would have to float his ark over England before you could flood this house from that river. But the insurer said, well, that may be the case, but we can void the policy, and so we're going to.
Right, well, thank you. So we felt that was an unfair decision, but in law, the insurer was entitled to exercise that option to void the cover. There's another case we looked at, which we're calling the shop on the cliff. And this was a similar case of a shop located at the top of a cliff, and by definition, the shop was close to water. But this had not been disclosed at inception. The insured submitted an impact claim following an unfortunate episode with a passing motorist. The loss adjuster queried whether there had been a non-disclosure in relation to the property's location. Both the adjuster and the insurer concluded that this was information that should have been disclosed. And it was also thought that the insurer would not have accepted the risk had it known the shop was so close to the cliff. I'm not too sure I'd want to insure a shop at the top of a cliff, and so it was generally agreed that cover wouldn't have been available. However, in this instance, the insurer concluded that the claim for impact had not been made any more likely to occur because of the non-disclosed location. And so the policy remained in force and the claim was paid. The insurer then reconsidered whether it was prepared to maintain cover now that the details of the location was known. That seems to us to have been a fair and proportionate response to the problem. But Roger, can you see any fundamental difference between these two cases, and why there should be a different outcome?
Well, no. They're both cases of non-disclosure, and they're both cases of claim, and they're both cases where there was no connection between a claim and the non-disclosure. That's the point. The non-disclosure didn't make any difference at all. But one insurer exercised their prerogative in voiding, and the other didn't. So,
is this where the lawyer's point of view often comes in? Because
well, it is.
A lawyer looking at these two cases would probably encourage the insurer to void the policy on both occasions because there had been a non-disclosure.
Yes, because the lawyer looks at the point from the point of view of the law, what the law provides, and the law, as I said earlier, it can be a bit of a blunt instrument. You've got to recognise that lawyers don't have any responsibility for commerciality. Insurance is a commercial contract. It's a bargain between two parties. And generally speaking, the seller of a good wants their customer to be satisfied. Lawyers have got nothing to do with that at all. They're not interested in satisfaction. They simply say, this is what the law can do. Now, there are some insurance practitioners who say, well, if a lawyer tells me that, I'll take advantage of it. And others say, well, thanks for your legal input, but I'm not going to take advantage of it because I don't want to, and I don't have to. And that's the difference.
Right. Well, thank you. Well, we've got a couple of other examples which are slightly different, and these are both consumer cases. And these are cases where we feel that voidance can be disproportionate and possibly not fair to the policyholder. And one phrase that's going to crop up from time to time here is the phrase scheme limits. So we'll have a discussion about that, what is meant by scheme limits. But Roger, can you just outline what the first case was all about, where there was serious underinsurance for the home itself?
Yeah, this was a consumer loss. There was a fire, and a serious one, and the property was gutted. It was soon established that the claim value would have significantly exceeded the sum insured. It was discovered, I think, that the full rebuilding cost was going to be something in the region of £700,000, and the sum insured was about £350,000. Now, originally, the insurer said that it wanted to void the policy, and this was on the basis that the insurance scheme under which the home was insured had been designed for small or medium-sized properties. And there was a scheme limit of £500,000. So it was established that if they'd insured for the proper sum, the insurers would never have insured it. Now, the point here is that the policyholder or the proposer will never know, ever, what a scheme limit is for an insurer, and nor do they need to. The point at risk here really is this, that if the insurer wants to protect itself against writing something in these circumstances, it really ought to say, if your property has a reinstatement value of more than 500, 600, 700, then this is not the scheme for you. Please go somewhere else. We can't accommodate you. And it's not good enough, and it really isn't good enough to say after the event, oh, well, had we known, it wouldn't have fit our scheme, because that's got nothing to do with the price of bread between the contract of the insured and the insurer. So it will fail. That really is the issue. That's it.
Well, could we have a look at another one? There was a case of a family that insured its home and contents, but they got the jewellery values all wrong. The family experienced a particularly distressing break-in, and a claim was submitted, and it was established that, in fact, the cost to replace the valuable items came to over £40,000, whereas on the statement of fact, there was a question or a statement to the effect that valuables did not exceed £10,000. So the insured had clearly got that totally wrong, and they should have declared a value of £40,000 if indeed they knew that the value was £40,000 at the time. And it was one of those cases where it was a family that had acquired a lot of jewellery and valuables on birthdays and high days, and they hadn't thought to ask their relatives how much this gold bangle or this bracelet was worth. So they were wrong-footed. Now, the similarity between this case and the buildings one is that this particular insurer says that their scheme limit for valuables is £20,000. So the fact that the valuables at risk were £40,000 clearly put it above the scheme limits. And when we looked at it, we thought that this was a little bit unusual, because there are many occasions when a home contents policy has a reasonable content sum insured, and the insured is asked what limit do they require for valuables. And in most cases, in the event of underinsurance on what is really a sublimit, we would normally expect the insurer to remark about the underinsurance insurance, but would probably pay up to the amount stated in the policy, and then work with the insurer to get the sums right for the future. But in this case, the insurer decided it was going to void the policy and didn't pay the claim at all. And in actual fact, the claim itself wasn't that big. The issue that had the main impact on the policyholder was the fact that they had avoidance that they would have to disclose in the future. And that was the problem there. So, Roger, we've talked about this sort of thing a few times, and we feel that there's a tendency in this sort of case for the insurance company to actually punish its own insured, where an innocent mistake has been made. Have you got anything to say on that issue of punishment?
Well, yes, I think the fundamental question is, why do we want to punish a customer? We've had it said time and time again in the last few years. In fact, it was said in the case of the house on the hill, we have to teach the insured a lesson. Well, sure, if you want to teach the insured a lesson, you tell them how to get it right. You teach them how to buy insurance safely, and you teach them what it is that really matters to you. But the problem we've got now is that in the last 20-odd years or so, we have removed the face of the insurance expert from the customer to the extent that the customer really is in the dark. And I think you've really got to ask yourself as an insurance practitioner, do I want to be in a business where I can punish my customer? Now, there are times to punish a customer, and that is when they have been dishonest or fraudulent or vexatious. I mean, there are a few that do that, but generally speaking, most of these situations are innocent. Now, when you look at the Insurance Act and CIDRA, one of the great things about those about that regulation, that's not even the right word either, but you know what I'm talking about. The great thing about it is that it did contemplate the question of carelessness or recklessness or dishonesty. And I think that's absolutely right. There are some people who are careless, and careless can have a very wide spectrum. My 96-year-old mother is careless, but I'm not going to punish her for it. If somebody of business status in their 40s is careless in doing something, then you might take a different view. You really should have known better. So carelessness has a very wide range of attitudes.
Roger,
I think it's something.
Sorry, Roger. Isn't there a danger that you're being a bit soft on underinsurance?
Well, underinsurance can always be remedied by average, and even if there isn't an average condition in the policy, which there isn't in some consumer policies, I think you could say, well, we're going to apply the principle because it's fair. The point about it is, if you're going to have a remedy to these things, try and make it fair, not unfair. And I think that voidance can be, in many cases, unfair, where there's a technicality of, if you like, misrepresentation or non-disclosure that really wasn't malice aforethought, as they would say in the criminal world.
Right. Well, thank you for that. We better just move on to have a think about the statement of fact, because we all know that a statement of fact or a proposal form should be phrased in such a way that it's clear and obvious, obviously designed in such a way as to draw out the information. But we see a lot of statements of fact, and sometimes we're a little bit confused ourselves as to how the insured was supposed to answer the questions. And we've put an example here of a statement of fact which is largely posed in the negative. I don't know if you know what I mean by that, but the insured could only answer yes or no. So, this property has not previously suffered from subsidence, heave or landslip or been underpinned. And you can well imagine an insured saying, no, of course not. Neither this or any adjacent property show any obvious signs of, no. Because in colloquial English, that's what you would do. But we think that what the insured is expecting here is for the proposer to put yes. And it takes a little bit of mental gymnastics sometimes to work out what the correct answer is. Now, you might think we're making too much of this, but we do see cases where the consumer is genuinely confused about these issues that are posed in the negative. And we've got something else to say about that.
It is a matter that regularly comes up in legal proceedings. And, I'm doing this pretty much every week. And the questions asked by counsel are, what does this question mean? Because it could mean two things. And bluntly, I have to say, yeah, you're right, it could mean two things, but that's just the way it's written. I mean, if you're asking me as an expert, what do I think it means? I'll tell you, I think it means this. But I agree with you, it is written in a way that it could mean two things. Now, we can do something about that as an industry. We can take more care in the way that we ask the question. I have a problem with statements of fact because they are often not well written, clearly written, and also I find that it's very difficult for a lot of people, particularly consumers, but not just consumers, I would say particularly smaller business, average businesses as well. If an insurer says you are not within 200 meters of a river, a number of people will say, well, they must know. They've got the technology to tell us. And it's not a stupid thing to say. And again, this comes out in litigation cases. The underwriter says, the lawyer will say, well, did the underwriter know that it was within 200 meters of the river? Well, yes, he did, because he has the technology to, well, why did he ask the question then? So what this comes back to with statements of fact, what we're trying to do with a statement of fact is fundamentally reintroduce what was called the basis clause. In other words, you're telling me that your risk is not within 200 meters of a river, or not within 30 meters or whatever, 20 meters of a tree, and I'm holding you to that fact, period. And in the times when we've got the ability to ask questions rather than make statements of fact, I still think the best thing to do to get the honesty and integrity between the insured and the insurer is ask them a plain question and make the answer very simple, yes or no, or here's the explanation. So I'm afraid, personally, I'm not in favour of statements of fact because I think they're causing more problems than they're worth.
We've actually got some recommendations on this issue that we've included in our fact sheet, but we haven't got time to go through those today. But please do download the fact sheet at the end of the webinar, and you can have a look at the recommendations that we're putting forward to the industry. But as we draw to a close, because we want to allow some time for questions and answers, there's this issue that we call the sting of voidance, and this is why we feel that sometimes avoidance is disproportionate and sometimes unfair, because of course it becomes something that the insured needs to disclose for future insurance, not only for his own home contents, but for his car and perhaps for a business. And there is no industry standard expected about this disclosure. So, the need to disclose past avoidance when applying for new cover at renewal, do you go back 10 years? Do you only go back 5 years? Is it something that has got to be disclosed forever? For instance, I've looked at two statements of fact on this issue within the last day or two. And one says, have you or any person usually living with you ever had an insurance policy cancelled refused, or had any special conditions applied. So that means ever. So, you know, for the next 20, 30, 40, 50 years, it's something that would have to be disclosed. Another one says, have you ever had home insurance cancelled or had renewal refused? And we find ourselves being asked by brokers, well, this happened 20 years ago. Do we need to disclose it? Well, probably yes. But actually, there's an interesting technicality here, Roger. We haven't really got too much time to talk about. But if a policy has been voided, the legal term is ab initio. In other words, the policy never existed in the first place. Now, I suppose you could argue that that policy has not actually been cancelled because it never existed. What do you think about that?
Well, I think it's exactly right. You know, cancellation and voidance are two entirely different things. Yeah, you're right.
So basically, it's a recipe for confusion, and we in our recommendations we're suggesting that the industry should adopt a standard policy of only asking for voidance going back 5 years. But that's something for you to take from our fact sheet to consider.
It's again, the question of how far do you go back is an important matter in reality, because when these things get into dispute, I'm often asked by counsel, and I say, well, why does it, when the insurer says ever, have you ever, blah, 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 why do they ask ever? Why don't they say within 3 years or 5 years or that? And I say, because that's the way they phrased it. They probably haven't thought about it particularly, but they want to be certain that it's never happened. So counsel will then say, well, if it happened 20 years ago, for example, a very common one at the moment is with matters of financial insolvency and bankruptcy and things like that. If something happened in a remote business 20 years ago, does that actually affect the risk? Now, I would say probably not, unless there was something of that the facts in that case concerning some degree of criminality. Where criminality is involved, you could say that ever is important. But on the other hand, the Rehabilitation of Offenders Act doesn't say that. So insurers sometimes want to go further than the Rehabilitation of Offenders Act would go. So the law will say, well, why do they want to do that? And very often I don't have an answer, or I don't have a good answer. And this is why I think that, particularly with technology, where we're having more and more of our industry and our industry, if you like, subject matter piled into algorithms, now is a really good time to sift out this stuff and see whether we can get some agreement amongst the industry to ask the similar question in the same way.
Roger, I'm going to stop you there. That's a good punchy conclusion, but I think we need to pass back to Carly now, because I'm sure we've got one or two questions that people might like to raise.
Yeah, okay.
Hello, thank you, Michael and Roger. Yes, we've had quite a few questions come in, as usual, so I'm going to start from the beginning. So we've had someone ask the question, or made the statement and asked the question, InsurTech has and is robbing us of our agency. The algorithms, if unchallenged, will become the case law if they are unchallenged. Are you able to comment on this?
Voluminously.
Well, you've got 30 seconds, Roger.
It's a question of where to start. Well, look, I mean, the point is, yes, you're right. And what we've got to do is to address it. I can't answer it in 30 seconds, but the point is, if case law becomes based upon these algorithms, our industry will die, because it won't work. It can't work. You've got to have flexibility in insurance. And I'll tell you why, because you cannot write an insurance contract perfectly. There's no contract of insurance which can manage all human and humane things all of the time in every circumstance. If it doesn't have flexibility in it, then it will fail. And eventually somebody will invent something different. I don't know what it will be, but something will happen. So we've got to address it if we want to keep insurance the way that we have enjoyed it so far.
Thank you. Another question from Ian Morrison. I've seen recently that the FCA dispute process is also treating business customers in the same manner as consumers. He's wanting to know if you've also seen this.
Yes, we have, yes. Yeah. And I think the point is that... You carry on, Mike.
Sorry, Roger, you carry on. No. I've seen a little bit of this in relation to things like late notification under a business policy, where an insurer would say, there's a late notification here, we're not going to deal with it. And the Ombudsman has looked at it more as it would do had it been a consumer, and would probably expect the insurer to demonstrate that the late notification has in some way prejudiced its position. Now, depending on your interpretation of the Insurance Act, you could say that the Ombudsman is not making those decisions in strict adherence to the Insurance Act. But on the other hand, the FOS is entitled to say, but we don't have to, because we make our decisions not strictly speaking in line with the law, but our remit is to decide cases based on what we consider to be fair and reasonable.
Thank you very much. Okay, so when considering your experience of insurer attempts to void policies, is there a pattern of what you might consider usual suspect insurers? So this is a bit controversial. He fully appreciates you're unable to name any insurers specifically.
I think it's fair to say that we could reel off on a couple of hands the insurers that we come across every time with the same attitude. And equally, there's a lot of insurers we never have a problem with because they just seem to do the right thing the right way. But I'm afraid it's culture. And there are some insurers that just want to use these remedies for whatever reason. So the answer is yes, there is a pattern. Yeah.
Yeah.
I think even more disturbing, if I could add, Carly, even more disturbing is that the insurer involved in the jewellery case that we mentioned, we've seen similar cases go to the Financial Ombudsman, and there are at least half a dozen examples against the same insurer where the policyholder has fallen into the same trap of getting the jewellery figures wrong. But there's no indication that the insurer has done anything about the problem because a pattern has developed. So it has become almost part of their business model. And we're a bit distressed at the signs that they're not doing anything about softening that or heading off the problem before it occurs. And I think that's even more serious.
Yeah, I think it is. I think it's very serious. And the other aspect that comes out of this is that when one goes, quite a lot of policyholders before they come to us, they've gone through the complaints process. And the complaints process is cynical because the complaint is given back to the original account handler to say, what do you think of this? They're complaining against you. Now, what do you expect somebody in that situation to do except to uphold his own decision? And I have to say, or we have to say, we think the complaints process now is becoming actually damaging to our industry. It's not serving its intended purpose. And we are coming across some insurers who are making monumentally obnoxious decisions. And even the lawyers that we speak to, they say, I can't believe that the insurer is doing this. But it's all because the distance. You see, the insurer, quite often, there's only a few of these people, but it's happening a lot. The insurer doesn't have the accountability of having to face up to the customer. They're so far away from them. They can say and they can do what they like, and they have no accountability. And then, of course, if you go to the complaints process and that doesn't work, there's nowhere else to go. Well, what we do is we write to the chief executive and say, actually, did you know this was going on in your company? And we've had one or two, in fact, one very recently who said, I did, and I'm happy with it. Now, what does the industry do in a situation where what Michael's just told you is actually, yeah, we're quite happy with that? Because the customers have got no idea when they're buying what they're buying.
We're motivated by fairness and reasonableness, and it's not just to the policyholder. When these things happen, it's not fair to the brokers either, and it's not fair to the more responsible
rest of the industry
insurers. Because the jewellery case we quoted, the premium wasn't enough, because I think the contents were insured for 75,000, the building was insured for £500,000 with jewellery, and the premium came to under £150. So they're undercutting the more responsible insurers, and then they're using these devices. And so if I was the CEO of one of the larger, more responsible insurers, I'd want to be doing something about this.
Yes, exactly. And to be fair, most of the people we write to are very, very good. You know, they say, my word, thanks for telling me, and we'll do something about it. But there are a few, and there is a pattern, that don't and won't. And that is of a concern to us, because that is where policyholders are entrapped into a system, into a culture. And it's a culture that the insurance industry can't afford to tolerate. You know, I spent 33 years broking, and a lot of underwriters used to say to me as broker, you know, we really have got to educate our insured that actually most of us are really quite good, quite straight, and quite honourable. And they were. But it only takes a very small number to do the opposite, to create a disproportionate opinion about our industry. And that's what's happening. And it's happening more because of insurtech, because of the remoteness. In other words, the insurers and even brokers, often brokers don't speak very much to their customers nowadays. It's all done by you know, telephone or email, not telephone, no, email or whatever. And there's not much more to say, really. We're reporting to you what's going on in the industry. It's not nice, some of it. But I do think all of it's remedial, and that's what we're trying to do with the CII. In fact, we're making a presentation in 2 or 3 weeks' time on recommendations concerning voidance, whereas we think actually all you need is not change of the law, but just a market agreement that actually in this situation we would do this, because it would make so much difference at so little cost.
Carly, have you got any more questions?
We do. We've got a lot of questions coming in. Next one for you. Do you find that FOS attitudes have changed over the last few years to further back consumers within a commercial insurance space regarding overturning voidances?
I'm sorry, that was a bit convoluted. I'm sorry, I know we're short of time.
Can you read that again?
Yeah.
I will take it.
So do you find that the FOS attitudes have changed over the last few years to further back consumers within a commercial insurance space regarding overturning voidances?
Right. I'm not too sure I quite understand what's behind that question, but can I just offer the opinion that I know insurers often complain that the FOS bends over backwards to support the consumer in this case. I don't think the statistics bear that out, and I think the proportion of claims that are upheld against the insurer has actually fallen during the last 10 years. So, and we feel that some insurers make more use of their panel solicitors to argue their case than perhaps they did previously, and maybe the respective strength of the parties is not as equal as it used to be. But apart from that, it's mere speculation. There are only so many conclusions that you can draw from the bare statistics.
Great, thank you. And should the ABI perhaps be lobbying for change to apply a more equitable approach?
Well, yes. I mean, I think that the ABI, being representative of insurers actually ought to be saying to the ABI, can you help us? And one of the reasons for that is that something that doesn't come up very often, but I'm quite aware of it from historical reasons. When we had the Competition Act imposed upon the insurance industry, it took away a lot of the collegiateness of the insurance community, because people were frightened of being convicted, if you like, for breaches of the Act. Now, the great thing about the insurance industry, actually it's quite a small industry in many ways, particularly the SME and the consumer. It's small to the extent that it's a fairly close, there's 300,000 people roughly in the industry. Now that's, not massive. And talking about what goes on, for example, I'll give you an example, a neutral example. The discussion that's going on at the moment in various places about the insurance of these new electric scooters. Now, that's something that the insurance industry ought to be able to collegiately talk about, collect their views, put their views, and come up with an answer. And the ABI ought to say, this is what we want to do. There are two reasons for it. One is that the danger with scooters is actually the third party rather than the rider. And personally, I think it's inequitable that people can be knocked over, but there's no opportunity to recover from the person that knocked them over, and that's not true of any other vehicle. But the point is, it's the kind of thing that the industry does so well when it gets together and talks about a problem. Now, another problem that the industry could do very, very well to talk about is, for example, how they're going to deal with the cladding situation and the timber frame building. Going forward in insurance, lots of people are trying to invoke the carbon objectives, and therefore that means timber. Now, unless the industry is allowed to get together to share and to talk and to be open about this, it is going to be fractured and factioned. And when you've got a factioned industry, you get menacing results, whether it's in the claims or whether it's in the insurance process up front. So I think that my view is the ABI, I think, can be a very, very powerful body of collating opinion and putting forward issues that advance the industry, whereas I often see it as a defensive. I've come to see the ABI as being defensive rather than opportunity grabbing as promoting the industry. But I might be wrong. That's just the way it comes across to us.
Thank you very much. We are out of time, unfortunately. Michael and Roger, we do have quite a few more questions. So for those of you who didn't have their questions answered, we will make sure that these get sent over to Roger and Michael so they can answer them for you at the end of this session.
Holly, can I just say, Holly, can I just say, you've said that before, and in fact, we haven't seen them, and we're worried that people think we don't care. If somebody's got a question and they want it, we don't mind if they email direct to us and say, can you help us? But I don't want people to think that we're not interested. Okay, no problem. Well, you can see Roger and Michael have just switched over the screen for you there. So there is a direct email address for you if you want to send these questions across to them. Apologies if you have asked questions in advance and they haven't made it over to Roger and Michael, but we will do our best to get these ones across at the end of this session. So thank you, Roger and Michael, for yet another really insightful and interesting webcast that you've delivered for our members. This session is available on demand now. The slides that you've seen are also attached and a fact sheet as well. So these are downloadable from the screen that you're currently looking at, along with your CPD certificate. And please do feel free to share this webcast with anyone you feel would benefit from it. And thank you everyone for joining us, taking the time out to view it. Thank you again to Flaxmans, Roger and Michael. We appreciate it as always, and we'll be in touch. And I hope everyone enjoys the rest of their week.
Thank you very much.
Thank you.
Thank you. Goodbye. Okay, bye-bye.
Bye.